Okay, welcome. Good to see you. I'm Tim Quast. It's March 23rd. This is the Market Structure Edge demo and discussion. Happy to have you here. Boy, we have a lot to talk about. And as ever, I will do my best to answer questions. But I have I want to talk about what we knew before the Fed meeting, because that data was, I felt like, very good in telling us how to be positioned and what it's telling us now. And I know that what I get notes about the most is, well, when should you do something? How do you know when to enter and exit? No matter what the data are telling you, what do you do? And we'll talk about that. There is the optimal, and then there are conditions that mean, well, maybe it's not perfect, but because the math is so good, you just have to take what the market gives you. So let's start with this. I'm going to share my screen. Go. Okay. So what did we know, and when did we know it? Ahead of the Fed meeting. I like to just do the same basic things. What's the broad sentiment doing? I like to look at the dashboard and look at the trend lines on the sectors and so on. What's the context? VIX options expired. Volatility as an asset class expired. Right in step with, as Jay Powell was making comments, it would be the new series that began trading. Technically, the outgoing series expired on Tuesday, but that's good to know, right? You want to know, well, that's occurring. And then what do the divergences tell us? Well, there wasn't much in momentum. There wasn't much in low volatility. It was a pretty cautionary signal. Let me just make sure I've got everybody here. Oh, we got Tim and Greg. Good. All right, Tim and Greg, we're just getting started here. You haven't missed much. So heading into the Fed meeting, we would absolutely know that the bias in the market was to the downside. And this is what I'm reiterating these things, pointing them out, so that you will know what to look for each time. That's the whole point. If we have falling supply and rising demand, the probability that the market rises is very high. If you have this condition, the market is certainly bottomed. Red line tells us that statistically we're at a top, and probably at some point within days to it can be even several weeks, as it was in here. The market's going to decline, but we have a very good signal. So we know that the market is very near bottom, but look how high supply is. That continues to be the threat to the market. Doesn't mean it's going to go down. That we'll go to data point number 2 when we look at what we know now. But this is what we knew heading into the Fed meeting. You'd look at that data and say, well, that's not very good. There's not much demand and there's an awful lot of supply. So if anybody stops what they're doing in reaction to whatever the Fed says, the market's going to go down. And then you could immediately look at your momentum and low volatility portfolios. Think low volatility had 6, this had 3. That's not good. So you would know, well, that's not, if you anything, you want to own a hedge under those conditions. And then finally, again, context, what's happening on the calendar. And you can go look at that very easily. Go into the landing page, marketstructureedge.com, click resources, look at the calendar. So that, I felt very good that we were well informed that there would be risk in the market.
You are not.
And so, one thing really quickly, folks, if you can, mute yourself, and that'll be helpful. There we go. And ask questions. As you know, ask questions via the chat or interrupt me. I forgot to mention that. Those are the only 2 ground rules. Mute yourself while we're having a discussion, but feel free to interrupt me and make sure that you ask questions that way or by chat. So this is what I feel like we had a pretty good sense of what might happen. If you look at the financial stocks, could they recover? Maybe. This is where we were with the Fed meeting, right here. So very high supply, very low demand. Passive money has been a seller of that group. The big financials is the usual suspects here. Better, in the sense that they're all the way at 1, meaning, well, you can't go any lower from a sentiment standpoint, from a demand perspective. You can from a price perspective. And on the supply side, this is a much lower level, 42% versus over here, if you back up a day right there to the 20th, 53%. So you look at that and say, well, the big stocks clearly the big banks, nothing's good in the sector right now, but are better off than the regionals and smaller banks, and you can know that. Right? Pretty easy to look at that data. Okay, so we all knew probably a pretty good chance that there was risk to the downside. Then you look at data this morning, and everything can change. It can change very rapidly, and there are things that I'm concerned about, particularly the high supply levels. That we can have a great run, and boom, the bottom can drop out because of that. And even today, the market was way up, and now it's not, and that's that headwind. It's like letting the tips of your skis drag in powder. All of a sudden, you slow down. That very same condition is reflected in very high levels of short volume. But look at this. You have this big jump, and the lead behavior is tech. Passive money's buying tech. Let me go. I heard a ding in my ear. I want to make sure we've got everybody. What am I missing? Okay. Here we go. There, now we can do it. That's what I was looking for. I was looking for that button. Okay. Okay. So what I would do, seeing that here's your lead, your top sector in momentum, is click through it. You want to look at them, and we're going to do that because I think that'll be helpful to look at entries and exits. But then I come down and look at big tech. Very strong demand. Supply is above trend, but still, it's ticked down day over day. It's at 45%, well below the market levels. Look at communication services, not the passive money leading. So asset allocation models are putting money into these things, and it may still be part of the rebalance activity that occurs right around particularly March. June, September, March and September more than June and December expirations periods. You look at communication services rising to, it's still below 5, but you look at all these data, it's more long than short. Those things look pretty good. You come down and look at tech. These are just things you can do very quickly to know. Well, it's not as good as those smaller groups, but still you have rising demand and falling supply that is now dropped below 50%. That all is good stuff. And then looking at momentum, just there you go. It's all big tech: Google, Amazon, Nvidia, Applied Materials, Microsoft, Meta. I pointed out that Meta has had really good supply-demand divergence. And if you're new, this is what I mean. You look at that whole period here of roughly 90 trading days back to December options expirations, and look at the amount of time it's spent above 5. Here's the only weak point. And if you left here, by the way, if supply is very high and demand falls and you left, you would have missed out on nothing. Nothing. I mean, you could go trade something else that's rising. And then as demand rises back over 5, supply is low, well, there you can return, or you wait till it hits 10 with supply down, and there's the rest of your gains. And it's happening again here. Demand hitting 10, supply down. That's a great time. You can pick up your several percentage points. You have very high probability of doing that, and that's how to use the data. You can put the whole picture together that way. See what broad supply and demand is in the broad market. What is it in the momentum portfolio? Oh, it's tech. Okay, let's look at tech. Let's look at big tech. There are a bunch of big tech names in there. All of that looks good, and that is precisely where you want to be. Okay, so questions about that before we talk next about, well, how do you know, when should you buy and sell? All that data is good, but how do you pull the trigger? That's the other thing. So fire away if you can. Let's see. I'm going to see if what I've missed here. Can we draw? Let me go to the top here. How are you coming with the short portfolio? Okay, I'll show you that, Gary. Thank you. Okay, just feel, yeah, true. It's true, Andrew. It is just doing that. Which companies do you track with financials? So what we do is with financials, we license S&P Global GICS data. So the S&P created the 11 general industry classification series sectors, GICS sectors. So that's how we do that, and that data set should keep it roughly aligned with what they've got. Big tech I have created, and I'll show you that. can we draw any conclusions from them being filled with just big tech? Well, I mean, I think it's just part of that is I can't say absolutely. I can certainly tell you what I think. That despite the good stretch that tech has had, Apple and Microsoft alone, and Apple's not on that list, interestingly, in the momentum group. But those two alone are 13% of the S&P 500. And even though tech has done well, it's probable that if money is going to go to work any place, overall, if you looked across the last year, that's where they're underweight. So I think that that's part of it, and it dovetails with options expirations and index rebalances here. Yeah, I don't agree. I don't look at breadth, but I realize those are very popular technical signals. I feel like supply and demand does a very nice job of doing that for us. But you're right. Why isn't Meta in the momentum list? It is, isn't it? Yeah, we're looking at it. It wasn't, but it's back to it. It dropped out of it because momentum is going to look. It's back. If demand falls, even though it didn't come back down to 5. Look, if things stay above 5, they tend to do well. But if there was one little period of weakness for Meta, it was right here. So with the math and the momentum portfolio, this isn't going to make the cut. It's looking for rising demand, falling supply, and in particular, this day-over-day decline. Certain level, and then a day-over-day decline, strong demand, and a certain amount of a standard deviation of, I think, at least 1 between the two. So it's looking for that stuff. There are multiple mathematical factors, and one of those things could be omitted, and then it won't make the list. But math is precise, on one hand precise, and on the other wholly inflexible. You might be right close to being in it, but the math isn't going to pick that up. It is in the portfolio, though. Okay, so Dana says the last week and a half, I decided it was best to sit. Hey, look, if there aren't many choices, there's absolutely nothing wrong with that choice, Dana. I routinely, around options expirations and events like this, will sit on my hands. I mean, unless you have a high probability of producing something better than you can do sitting on your hands, then you should sit on your hands. There's no question. And particularly if you're risk averse and you're concerned about having exposure during periods where, what the Federal Reserve, the bets around that's just risky stuff now. It's a fact. Options expirations, it's risky. So I agree wholly. Okay, so now let's talk about what do you do? When do you buy and sell things? There's the optimal. The optimal would be, you look at something, it's got rising demand, falling supply, and then it's down, 1.5, 2, maybe 3%. If there's momentum in the market, the probability that produces a return is very high, but it doesn't always work that way, does it? That's kind of the optimal. And if you see 10 stocks in the momentum portfolio, and that broad sentiment is basically bottomed, and the tech sector looks good, communication sector looks good, big tech looks good, and 7 of the components of the momentum portfolio are big tech stocks, boy, the odds are in your favor. So ideally, you'd have a little entry point, but you don't have to. I mean, with that kind of math, even if a stock is up 1%, if it's up 3.5%, boy, you might have missed it, but if it's up 1%, you buy it and it goes up 3.5 or 4%. Now you've largely exhausted that opportunity, and it might be wise to take gains. You can always come back if it pulls back and the math hasn't changed. You still have strong demand and falling supply. The probability that you can repeat that gain is very high. The core is just to know that as many things as possible are pulling in the direction that you want to go. That's the key. So questions, comments, observations around that, your own experiences. If any of you want to weigh in and say, hey, this is something I've learned, please feel free. And I want to go down here, Barry Norton, to your point. What I trade, the only shorting I do, as I've explained, is with a hedge, like SH. because I'm trading in a retirement account and so I can't short out of that. I can short using ETFs. It's a workaround. But this is to your point, Barry. Okay, it's 5. I thought it was 6. But my short beta, which is going to look for these conditions, you can see it right here on the dashboard. I want supply that is falling or supply that is surging and demand that's falling. Basically, as Barry said, the reverse of momentum. And this had scores of stocks in it, 4 or 5 days ago. And so now it's down to 5. And interestingly, it's utilities. Utilities is the lead group. And you look at utilities, surging supply and demand that's ticking up, but it's pretty, they tend to hang out around 5 anyway. Here was a great time to own utilities when demand was at 5 and supply was plunging because people got very concerned about this banking situation. So that's where the money went to hide, using utilities as a way to offset the risk in financials and other parts of the market. Well, that's reversed for now. And by the way, let's look at financials again and say, well, where are we? I did this a little bit at the beginning, and some of you missed this. You look at financials, well over 50% short. So the demand is very weak. It could recover. There's no question that demand could come back into them. But I look at both of these and say, this is not the place to be. Just compare them to big tech. Look at big tech here. Supply is well below 50% and demand is surging. Well, which thing would you pick if you're trading long? Clearly, the math is here on your side. Okay, now before we get to, I want to look at the momentum stocks as an example. I'm going to pause again and see if there's any questions. Let's see, I missed one, didn't I? I saw somebody. Pardon me if it looks like I'm hitting you in the face with my finger. I know I saw. Tim, which companies do you track with financials? Okay, right. I'll show you that. Let me show you what companies are in that big financials portfolio. With big tech downside right now, is it better to buy now or wait until tomorrow morning after receiving tonight's market structure data? Well, that's a very good question. If the gains go away out of tech, you've just been given a gift. I'm not saying that. The only qualifier is I'm concerned about the high levels of shorting. It's a Friday. I like, if it's possible to take gains over and sit out over a weekend, I do. I don't do it all the time. I mean, it just depends on what the market has done. But at present, you would say that's a pretty good mathematical bet that the market might do the same thing tomorrow, where it gives you an early opportunity and then it fades. All of that has to do with the heavy amount of shorting in the market to me. But I would look at that as an opportunity. What's an indicator on that tells us we're getting a turn? Okay. Short volume drop below trend or broad sentiment turns up from. Okay, that's a great question. WM, glad to hear it, Gary. That's what we love to hear. All right, so 2 things in there: the signals and what's in the big financials portfolio. So these are the ones I use just to track this group. So Wells Fargo, Citi, Bank of America, Goldman Sachs. I put American Express in there because they've really gotten to be a big player in banking. It's the outlier, though, I'll grant you. Morgan Stanley, JP Morgan. And so, you look at all of them, they're all bottom. Only JP Morgan is starting to rise. It's kind of ahead of the pack. And then look at these levels. The worst would be Morgan Stanley, interestingly, 62% short. Then going to the other question about here, when do you know? Well, optimally, when the demand side bottoms, that's generally a good time. Notice here that supply had fallen and demand had fallen. Supply jumped again, no question. It created some volatility in the market, but then it dropped back down. We had a great run right to options expirations, pretty good divot here, but that's really it. I like to see the demand side bottom and ideally the supply side come down too. Which one is the higher priority? Well, if one were picking one or the other, demand outweighs supply. But if supply is high, the ability of demand to provide sustainable gains is weaker. And you get these kind of things happening. Big jump, because see, it's bottomed, big jump, but then it gives it back because supply was so high. And so that this will always introduce a little additional risk. And then what you have to do is go find the things that are best. That's what momentum's trying to do for us. It's saying, okay, we can see the conditions in the market that might create momentum. What are the things that have the highest probability of letting us take advantage of it? And it's not perfect, but the math will do a pretty good job of giving those to us. Okay. Then back here, this is next thing to continue talking about entries and exits. If you looked at these, this is a good exercise. You look at Google, how do you figure out which of these is best and then what to do? Well, that's pretty good, but it's not back to 10. There's always a risk that this happens. In any stock that's not all the way to 10, there is always the probability that demand stops rising. So you just have to realize this is not bad at all. It's showing the math has picked that and said, well, it's between 8 and 10, and it's got the other mathematical characteristics we look for. But I would put that a little lower than I would put something that's already at 10 and just got there. If it says 10 and up, I know it just got to 10, and it's the Hicks rule. It's mathematically substantiable that consistently produces the best gains. Amazon, I mean, it's not bad, right? The reason it shows up here is because the supply side declined day over day. It's very low at 39%. It has rising demand. Is it a steep divergence? Well, it's not as good, again, as a couple of others, but that's what you look for. And you can also do this. You look at, well, what's the volatility? If all other things being equal, you can get something that has 4% volatility. Well, I'd probably take that over 3 because I have a better chance of getting a meaningful return. So let's look at NVIDIA. And in these, I highlighted Applied Materials because I think it's stronger. This is fine. There's a day over day downtick, but it's at 47.8%, and this is not awesome. I prefer that really strong, sharp supply demand divergence. And I'm just looking at it visually. There's no mystery or magic to it. I look at that and say, well, it's probably going to give us gains, and it did. At least first part of the day, it did. And if you have a chance to get 4% in that, take it. That's what you do. Coming to Applied Materials, and here's why this to me was a pretty good thing to look at. So pretty good, not awesome, but an okay demand graph here. But look at the supply side, really sharp drop off, dropping back below 50%. And that probably, it's a big liquid stock, probably a very good chance mathematically that delivers a return. So that's the reason I pointed that out. And then you look at, let's just continue here, Microsoft on back to Meta. And here, why not Microsoft? Well, it's fine, but notice that it's ticking down day over day, but it's minute. There's not much movement. There's nothing wrong with that. It's 37% short. That's a good solid stock. It's got rising demand. Nothing wrong with that at all. But if you want to if you want a higher chance of return, NVIDIA and Applied Materials offer it. And then I come around to Meta, which has 3.5% volatility there. See that? But again, very, very strong supply demand divergence. And it's got this great history of there's excess demand. Isn't that funny? Because you back up 6 months and Meta was the worst stock in the market, or very close to it. Meta and NVIDIA were just terrible performers. And now it's reversed. It's just the importance of how, to me, story doesn't determine that outcome. It is wherever the money's going. It's all that money that looks at stocks as products. And that is the big passives. I've said this before, that if you take BlackRock, Vanguard, Fidelity, which is classically an active stock picker, but they've shifted very heavily toward ETFs. State Street, UBS, JP Morgan, Morgan Stanley, you take those firms and 70% of the assets at those 7 firms, very large managers, I think that's 40-some trillion dollars of assets under management, put it all together, pretty close to that. They're following models. Target date funds, 60-40, whatever the mix is. Low volatility, all that kind of stuff, that's going to be in models, and they see stocks as products and they're looking for stuff they can get in and out of. The characteristics matter a lot, and we're going to see that in the math like this. And so that's what we're looking for. Okay, so I want to leave plenty of time to very quickly talk about what's next and to make sure that we've answered all the questions here. Feel free to comment too. You guys know, any of you can weigh in. Dan, if you got observations, or Steve, you got your hand up, go for it.
Okay, I have a question regarding whether or not you've ever run data on the length of time from the time that, we've all talked about when your demand hits 10 and you've got a drop in supply.
Right.
Have you ever run any kind of data on what the average time frame is that you will see that shift start taking place? Let's just say 2%.
And so if by that you mean, have we run math to see how long it takes to produce the 2%? That's the question.
Correct.
I'll say a qualified yes. And the reason I say qualified is we have a fairly blunt instrument for looking at the probability and the size of the return. And it's not neatly honed right down to, in fact, I've got data in front of me that does some of that. I just had Nate spit some of this data out looking at low volatility for that piece of the puzzle. So we continue to look at that data, and I'm not comfortable that we have it sorted out yet. You've done a fair amount of looking at it.
I did two times. I did 30-day studies on it, and the average was 2.5 days.
Yep. Okay. That's that's pretty close to my typical trading period. It would be 3 days or less. Now, it doesn't always work that way. As I've told you, I'm sitting on this lousy EQT position because I just decided I'm going to wait for the next exit. And that money is costing me because I can't use it to go do things that I know I should be doing. But, you make decisions about it. But 3 days is just about right. Yeah. Barry, what you got?
So what I've noticed is I've been watching what Steve just talked about, but taking the momentum and doing the inverse where I don't change any of the liquidity factors that it looks at, but just the timing. Last week I saw the negative momentum averaging anywhere between 50 and 86 stocks. Then Monday I come in and, we're at like 129. And what I saw was the market was selling the crap, but buying all the big stuff. And the data showed it in the various portfolios. And I'm getting to the point now to where I can say, okay, I can look at the negativity and see the quality that they're selling, right? And inversely, in the momentum, you can see the same thing as well, the quality that they're buying. And a lot of the quality that was negative had really crappy options liquidity. And so I said, okay, last week and this week, they're selling all the crap and they're buying the big stuff. But eventually, because the broad sentiment was saying, rising supply, et cetera, that, either at the Fed or post-Fed, the market was not going to be happy. Yep. And so it's just interesting now how I've been able to kind of take that and kind of extrapolate a broader market theory about the direction we're going to go.
That's good stuff. That's good. Seeing what's being removed and what's being added. That's good, Barry. I appreciate that. Let's see, Tim. In this market, is the daily active trading take the gain versus swing a better strategy? Tim, any time to me that you can if you get a 2 or 3% gain, take it. I just think I have a hard and look. I'll accept a counter argument if anybody's got a counter argument and says, "Well, then you miss out on something." I just have a hard time concluding that isn't the best way to produce gains. You might as well take it. You could always come back and buy it again. And I realize there are transaction costs and that sort of thing that are involved, but that's my position. Let's see, Jay. Somebody else will have to answer this one for Jason. How many days do you typically hold? 3? 3 that's good. Most of the time, if something's hitting 10 and has drop and falling supply, momentum's going to pick that up. that within, kind of like what Steve found in those 30-day studies, probably within 3 days, you're going to get your 2% return. You might as well take it and go find something else. You don't have to do that. I don't do it every time. There are times when, I just look at the supply and demand. And if the supply and demand equation hasn't changed, then I stay. I'm busy and I can't always spend the amount of time that I need to. If I don't have time, I just use the math. Once the supply or demand deteriorate, if I'm paying attention, then I move on, because I know that given my only, there's only so much time I can spend looking at this, that I'm going to trust the math rather than take chances. But most of the time, I'm going to be pretty short, just like Steve. I would say if I looked at my trading, historically, it's very close to 3 days. That's would be a good peg.
And typically, I've found the best entries are when you've got something in momentum, and it's got a volatility of 3 or 4 or 5%, and it opens up and it's down, and you've talked about it. For me, those seem to be the best home runs, because the math is going to reverse, and you're being given a gift.
Wholeheartedly agree. I will take that every time. Those are golden opportunities, and I do. If I've got resources, anything I put in the market desk note, if that opportunity opens up, as Barry said, that is golden. Take volatility into account. Or is that the same thing as supply and demand? Yes, it does take it into account. We use an average read on volatility across the market as a factor in how we calculate supply and demand. So it's in there. The reason we highlight volatility is to give you just an idea. I mean, how do you know what you might make or how much a stock should move? Well, it's a great way to do that. It's not perfect, and it can be affected by factors around it, but that's the way to think about it. Yes, right, like Meta. Exactly. I mean, it's just a great opportunity, right? There are some really good opportunities here that are developing, and that's all kind of a gift from high short volume. Market charges out of the gate, and then short volume drags it down. Supply drags it down because people stop what they're doing. If there are a bunch of orders to buy things at the beginning of the day and they get consumed and they bought their stuff, then prices will immediately deteriorate. So you may have multiple opportunities. Let's see. The spreads, that is not my area of expertise. So if somebody wants to, Ray, thank you for weighing in on that. I don't know what to tell you, Jason. I haven't ventured into that part of the market because I just don't have time, and I have to learn things. I have to aim small, miss small, put time in the saddle, make mistakes, get comfortable, and I can't answer that question for you. But if somebody wants to weigh in, feel free. Any options experts, have at it.
I typically do spreads because, like on applied materials today, if I looked at it, but I already have positions in applied, so I couldn't take it. But that's a classic example where I would, probably go into a spread at the open based on the data. And if it went against me, then I could close the short side and let the long side run, or just stay hedged and just let the spread work. But you need to do it on stocks that have the right liquidity in the option chains. You can't do it on every stock.
Yep. Good input. Okay, last thing. Let's talk very quickly about what's next. Okay, we know, what do we have ahead? Well, index futures. So looking back, that's these single ones right here. I'm going to just zoom this in. They're not as impactful, and I don't pay as much attention to them, but they're guideposts, and you should be aware of them. So index futures expire each month, last trading day of each month. There, and here are the last 3. And they've all had substantial moves right before or after. Here it was right before. Here it was right after. Here it was, right after, and then we gave it back. So you just have to be aware that that's there. And what's going to determine which direction it goes? Well, I'd look at that and say, generally, it's if demand has effectively bottomed. It bottomed here too. We had this a top here, and then this is a shallow bottom. It never got back down below 5, and so that probably it's not a great entry point, but it certainly tells us that the market's going to continue to run for a bit. And so that was true each of these times. A bottom above 5, and here just getting to 4. But the supply side was very high. So I don't know what it's going to do, but you should just be aware that that will have an effect, because there are trillions of dollars that use these, particularly S&P index futures, either to square, if you have stocks that really move, you will need futures to get you back in line with the index. And that's what they use those for. They're just big baskets of those. We used to have a guy on our client services team who he used to be a buy-side trader for I think it was State Street. Was it? No, it was BNY Mellon. It was BNY Mellon. His whole job buying and selling baskets of futures around these things to square the index positions. So just be aware that that's there. If this doesn't come down, if the supply side does not come down, the run's going to be short, and we'll probably see that in deteriorating momentum. The portfolio. If it does, look, we may have some room here. We'll find out. The banking crisis is not over. All these troubles that are bubbling just below the surface, that stuff's going to come back. But we're trying to just use the math to make money where the opportunity presents itself. Okay, good enough for this week. I think we covered a lot of ground. Appreciate that. Good to see everybody. Thanks for the good interactivity. That helps everybody. So. Thank you for doing that.
Quick question.
Yes, sir.
Okay, where do we find the list of banks that are most vulnerable?
So here's, what I would do is this. It's not perfect, but it's a good way to look at it. Just come down to financials and sort by short volume, right? Just do this. Come in here and do supply, and you could probably look at all the stuff that is 70 to 80% short, and that stuff probably isn't great. And then you could look at the ones that are larger. I mean, the worst one on here that's fairly large, what is this? Credit Acceptance Corp. So I'd have to look at that, but that's a really quick way to go isolate a list and say, let me go look at some of these. And what I did is I looked at the dollars per trade. These are very small banks, and you can look at the market cap and you'll know, but the dollars per trade will tell you right away. But these are all banks to me that one should be looking at. Interestingly, SIVB was on that list. First Republic was on that list. Western Alliance Bancorp was on that. Those they were all on that. So that's my answer, Steve. Okay.
Thank you.
Very good. Good to see everybody. Yes.
Hey, one last one. Did you get that interactive broker email that I guess people were a little concerned about the how the brokers were doing after the discussion last week that we had? And looks like they're heading it off at the pass and trying to make sure everybody feels good about it, that they're healthy and so forth. So I didn't know if you had seen that. And he also said that I guess they're going to give interest rate that's 0.5% under the Fed interest. So I guess that 408 should go bump up some then, I guess.
It should. Exactly. That's exactly what Thomas Peterfy said they do. Yeah. They're parking cash at the Fed and using the Fed funds rate, and then keeping 50 basis points of it and giving the rest to customers. And I feel I would feel better about those Schwab and Interactive Brokers and anybody who's doing that than I would about banks, because banks have their two sides of the ledger. It's not that it's not that brokers don't have value at risk, but they don't have a loan portfolio. They don't, they're not encountering this, to me, very simple thing that happened. Everybody carries tier 1 capital. They have to under banking laws, and interest rates rise. The value of the coupon moves inversely with rates, and their balance sheets devalue. And why the Fed wasn't completely aware of that is stupefying to me. That they would not recognize that risk, which is pervasive, and it has not gone away. And I think it could mean that the Fed has to very quickly change course. Could be within a matter of months, to me, that they would have to start to cut rates because of balance sheets, nothing more. You can't wipe out the entire banking system. Yeah.
All right, well, thank you.
You got it. All right, you guys. Have a good weekend. Catch you next week.